Welcome back. This is Josh Lewis with BuyWise Mortgage, back with the coronavirus mortgage market update for Thursday, April 9th, 2020. Thank you for joining us. Wanted to let you know that we have a couple of new technologies that we're using tonight. So if there's any glitches or anything, forgive me. What this is going to do is going to allow us to stream to multiple places. Some of you are on Facebook. We got some folks on LinkedIn, some other folks on the YouTube channel. So this allows us to broadcast to all places at once. So whatever's easiest and most convenient for you. Most importantly, it allows me to share some additional information here on the screen. A lot of the stuff is information dense, and I know you're not wanting to read or necessarily look at the video here, but some of this information is just a heck of a lot easier to give to you in a visual format. So without any further introduction, let's jump into it and make it a little bit bigger over here to see, make me a little smaller. Wanted to bring up the mortgage bond chart. Not that to a consumer it means a whole heck of a lot. I just want to kind of show what the chaos was. So this is back from January 1. So when bond prices go up, rates go down. So you can see we had a nice, slow, steady increase in bond prices, decrease in interest rates from January through the end of February. That was largely due to the coronavirus, but at that point in time, it was all isolated over in China. No one thought it was really going to be an issue or much of an issue in the United States. Now we flash forward here to March 9th. This is about when we had a little bit of a panic here in the US, starting to realize it was going to be a problem for us as well. We had a Fed rate cut right in here that made it really good for interest rates on this morning. And then the market started going, hey, if the Fed's making a big rate cut, we could have bigger problems. So we saw mortgage rates or bond prices go down, rates go way up. And then right here, this was the Fed jumping in on a weekend with massive stimulus, cutting overnight interest rates, the rates that banks lend to each other, to 0%. And we saw the market recover. But the big thing I want you to see here is just volatility. Big green candle, big red candle, big green candle, big intraday moves. Like if you look here just on, it looks like March 21st, 22nd, we saw the market from the best levels to the worst levels cover what took over 60 days. So just a long way of saying we had a big period here where the markets were just chaos and not knowing what they were doing. What we've seen over the last 7 to 10 days is mortgage bond prices are really high, meaning rates are really low, at least for the mortgage-backed securities that are being sold in the secondary markets. But most importantly, just want to see this stability. So we have a lot of instability and volatility in mortgages as they are consumer facing. And we'll get into that and talk about some of those reasons tonight. But on the back end, at least the way they're trading in the market, thanks to Fed buying, has been pretty stable, which leads us to believe that at some point we're going to see more of the benefit passing along to consumers. We just for now want to see this stability. This is in the secondary mortgage markets where closed mortgages sell. The chaos we're seeing right now is in servicing markets, and that's what's causing our rate sheets to have a giant disconnect. Usually I can look at this chart here on a day-to-day basis and tell you exactly what our rate sheets are going to look like because of massive disconnects in the servicing market, meaning the people that pay for the rights to collect your monthly payments on your mortgage. That's where we're seeing the issues right now. And it's something we'll probably get into next week, at least as it relates to consumers. But let's look here. What does that mean for interest rates? As of today, we saw that a little 20 basis point improvement in mortgage bonds. We've been telling you for most of the week for the best qualified borrowers, the little disclaimers you see on national lenders' websites, 70% or lower loan to value, 740 plus FICO score, purchase or rate and term refinance. These are the rates we're looking at. 3.375 with 0 points. That's down about 1/8% from what we've seen most of the week. So that's a little bit of an improvement. Now, that's for loans under $510,000, $400,000. If you're in an area, high cost area, for us here in California, Orange County, LA County, San Diego County doesn't quite go as high as Orange and LA County, but they allow loans above $510,400 to still be underwritten to Fannie Mae, Freddie Mac guidelines for reasons that we can get into later on Monday's report. Servicers just don't want those loans right now. They have too many of them. Fannie and Freddie dictate that they're not supposed to have more than 10% of their production in high balance loans. Because of that, instead of 3.375 at 0 points, we will be looking all the way up at 4% with 0 points. Or if you wanted the same rate, you would pay 1.25 points. So just as an example, $600,000 loan, which would be a high balance, you're going to pay $7,500 to get that loan, whereas the person with a $500,000 loan is going to get it for 0 points. We expect this to correct and normalize at some point, but I wouldn't expect it in the next week or two. We've got some big issues in the servicing markets, and until that clears out, you're probably going to see that difference. Now on FHA, again, some nice improvements. My best price lenders of today, for that best qualified borrower, 2.875%. with a 0.5% lender credit. So you're taking out a $400,000 loan, they're giving you $2,000 towards your closing costs. Now, if we kick up to a high balance loan, it's even worse of a discrepancy. So you want a $600,000 FHA loan in LA County, you're looking at 3.75 at a 0.3 cost. So you're going to pay $1,800 on that $600,000 loan to get a rate almost a full percent higher than the standard balance. So what I kind of wanted to talk about here tonight was what makes sense. Does it make sense to refinance now? If you're buying and you're in the market, totally different question, and we can talk about that at another time. But right now, who does it make sense to refinance, and does it make sense to refinance? Yes, absolutely yes, if the numbers make sense. If you can lower your interest rate, and you probably can on a loan of $510,400 and below, you can also make things make sense. We have a lot of people with really good interest rates. In 2013, 2014, 2015, rates were really low. A lot of people were able to take advantage. So let's say you have a 3.75 interest rate from 2014, and the rate today, which high balance, we would be at 4%. Well, you say that doesn't make sense to take a higher interest rate. But in times like this, where cash is king in two different ways, both cash flow on a monthly basis and having cash in the bank, it can absolutely make sense with the big run up we've seen in the last 5 to 7 years in home values. If you have $400,000 or $500,000 of home equity and $60,000 or $70,000 of high interest consumer debt or high monthly payment consumer debt, we can consolidate that. And I don't want to go back and flash back to 2003, 2004, when everyone was saying, hey, pull your home equity out, pay off all your credit cards, and then run your credit cards up. I think most people learned that lesson. They're not going to do that. But we also want to look at, hey, if we take that new loan, but we're increasing cash flow on a monthly basis, $700, $800, $900, let's take that monthly savings over the next 2, 3, 4, 6 months to get through the crisis. And then once things are back to normal, income's normalized, you're comfortable with your job security, the economy's good, then let's look at taking $500 of that and putting it towards extra principal and chopping that loan term down and getting things back on an efficient basis. When we just look at the efficiency of it, if we have X amount of debt, how do we get it at the lowest rate with the highest tax deductibility and the shortest term, so we have the total cost of borrowing over the life of that loan low? And we have some really cool spreadsheets and analysis that make it really easy for you to visualize that if you're considering it. The other one is just a plain cash out refinance. Got some clients right now, they owe $300,000 on their homes in LA County that are now worth $650,000, $700,000. Saying, you know what? I'm going to take $100,000. I'm going to put it in my bank account. I don't need it. My job's secure, but I'm going to feel a heck of a lot better with $100,000 in the bank if things really went sideways. So if you still have the job and the ability to qualify, this is a really good way to benefit. Now, who is probably not in a position where it makes sense to refinance? Those loans over $510,400, a lot of those people were also able to get a rate under 4%. If you're at 3.75 with a $550,000, $600,000 loan, and you call and say, hey, all I want is a lower interest rate, that loan today doesn't make sense. At some point, it's going to. And again, as we have more time and go to it in longer market updates, there's reasons why everything that's happening down now will lead to lower interest rates at some point down the line. The big worry is what do home values look like at that point? Are they lower? Do you still qualify? Do we still have enough equity? And then the second piece of it is what do loan guidelines look like? So that's why I wouldn't wait for the lower interest rates if it makes sense now, but don't feel like you're missing out, because we are entering into a deflationary market that should lead to lower interest rates down the line. Now, if you have a jumbo loan or a non-QM loan, non-QM loans are weird things like rental property loan where you're not qualifying off of your income, you're qualifying off of the rent, or you're a business owner, your tax return doesn't support your income, and you're using bank statements to show how much you earn, those are virtually non-existent. We do have a handful of lenders that say they're still closing them. They're getting much higher interest rates than what they were getting just a few weeks ago, 1.5%, 2% higher. So unless you're in dire straits and absolutely need the money, probably not the best time to get one of those loans. So let's look. What I really want to get into, we've had some major guideline changes. Now, I put temporary question mark just because anytime we go through chaos like we're going through in the markets, things change. There's going to be a new normal. Things are going to look different than what they look like right now. But for the most part, I do think these are temporary guideline changes. The biggest issue, again, we're talking about servicing. A new loan goes on the books, an investor owning a loan and the servicer owning the servicing to a new loan. The worst thing they can have is they put a loan on the books that qualifies today, but because of the chaos, that person doesn't have a job in 6 weeks and isn't able to make the payments. So most of these policies relate to being super conservative and making sure that people have jobs, have stable income, and that we're not qualifying off of 2019 income that's going to be significantly higher than 2020. So let's get the first one here. Age of documentation. As recently as 2-3 weeks ago, you could have a bank statement in your file 120 days old at closing. For obvious reasons, with the market down, lenders can't have that right now. Fannie Freddie FHA VA guidance right now is 60 days. The reality is most lenders are going to want and require 30 days. They're going to want the absolute most recent statement to show that you still have money in the bank, you still have money in your 401k, you still have money in your brokerage account. So just be prepared. If you've been in process for a while, if you've been in a long escrow, you're going to update all your documentation at closing, whereas strong buyers didn't have to worry about that as much in the recent past. Now, verification of employment. Typically, we have where you had to verify within 10 days of closing. So you're in a 45-day escrow. We get within 10 days of closing. That's about the time when your loan docs are going out. The lender is going to call and just get on the phone with your employer and say, hey, does Joe still work there? Hey, does Susie still have a job? They're not verifying income. They just want to make sure that you still have the job that they verified. Now, the guidelines are not quite as stringent on paper as they are in reality. Nearly every lender, before they're sending your loan docs, within 24 hours of that is going to either get on the phone with your employer or get an email from your employer from a work email address that gives them good contact information and verifying that both you are employed and you have not received or suffered a recent reduction in hours income, that type of stuff. Now, self-employed, this is where it gets really interesting. The guidance is kind of all over the place and every lender is interpreting this in their own way. I wouldn't say the most conservative, I'd say the most aggressive is how it reads in writing. Verify that the business is open and operating within 10 days of closing. Now, Fannie and Freddie have given some guidance of how you would do that. An example that I have is a hairdresser right now. She cannot operate her salon because we're on a stay-at-home order. It's not an essential business. There's no income coming in. Now, she does have product sales online, and we can use and document that income. So now we get into a dicey area. Some income's good, some income's not. So what we're seeing is some lenders are just giving a 25% haircut. Hey, if you can show the business is operating, that's great. I still want to take 25% off because I don't think any business is going to do as good this year as they did last year just because of the slowdown. So if you are self-employed and you are getting a loan right now, or you're thinking about getting a loan, this is really important to go through it and be able to explain and document to your underwriter, and your loan officer is going to present that to your underwriter, that you have not suffered from the downturn in income, or any downturn in income is still enough for you to qualify. Another one is market-based assets. So not your checking and savings account, but your 401k, funds that you have in a brokerage account, invested funds. If it's used for your down payment or your closing costs, we have to document the proceeds from liquidation. So say you needed $50,000 for your down payment and you had $65,000 in a brokerage account at Schwab. We now have to document that you took that money out of there. So we need to see the transaction that, hey, it was 65, it went down to 60, you were able to take that 50 out, and we verify it. Now, let's say that's a 401k account and we're using that for reserves only. As recently as a month ago, we were using 100% of that. So if you need 3 months reserves, you would use 100% of the balance in your 401k. Now we're using 70%, and this one often relates back to the age of the documentation. A lot of 401k accounts only update and provide a statement quarterly. Well, a lot's changed in the last quarter, so we're going to require some type of proof, either a recent statement or an activity printout showing your current balance. So big one here, and this one here is actually for the most part good for everyone. Temporary appraisal requirements. We're getting some relaxation of guidelines. Other than situations where you have a property inspection waiver or ACE is what Freddie Mac calls it, an automated collateral evaluation. If you don't have a waiver where an appraisal isn't required, we typically need a full interior inspection of your home. Exterior only appraisals and desktop appraisals where they don't come out at all, the appraiser just does the valuation from their computer. Those were not acceptable. Now, for the most part, here's the guidelines. On a purchase, you can use an exterior only appraisal if your home is located in an area that's suffering from a stay-at-home order, which hopefully for most of the United States right now, that applies. Lenders are also saying they'll accept a desktop appraisal where the appraiser doesn't come inspect the property at all. They do everything from the office. I would be super careful on this. I would hate to order a desktop appraisal, think you're good, and then the 11th hour have to have that exterior only appraisal. So at BuyWise Mortgage, we're ordering exterior only appraisals on everything that fits these categories. This generally applies to a rate and term refinance as well. They'll accept that exterior only, not the desktop, but the exterior only. The only things that we're looking at needing full appraisals right now are for cash out refinances. VA offers some leeway on this, but most lenders are going to require the full appraisal. So you might as well just plan on it. So wanted to give an update. You're probably just getting buried and inundated with information, whether it's just news headlines, things in your Facebook feed. Hey, there's forbearance. You can take a month or 3 months or 6 months or up to 12 months off of your mortgage payment. So what is forbearance? Forbearance is simply an agreement that allows borrowers experiencing a temporary hardship to make a reduced mortgage payment or no payment at all for the duration of the term of the forbearance agreement. What's super uncertain, I guess here's what I say, what I should say is what we know right now. As part of the CARES Act, the $2.2 trillion stimulus package, the FHFA, part of the government, has told any holder of federally backed mortgages, so FHA, VA, USDA, Fannie Mae, Freddie Mac, they've all been instructed that you need to that you need to offer forbearance to anyone stating that they are suffering a reduction in income, temporary or permanent reduction in income due to coronavirus. So big questions around this. On government loans, FHA, VA, USDA, the government has offered some help to servicers that are going to suffer some pretty big losses from being forced to offer forbearance. And they have not done that on Fannie Mae and Freddie Mac loans. So we're hoping that something comes out in the next week. Again, as a consumer, that doesn't much matter. What you want to know is, am I eligible for forbearance? Is it a good idea? And what are the long-term ramifications? So the good news is we've created a tool. My partner, Scott Shang, has spent about 50 hours in the last week putting this website together. It's forbearancereport.com. Gives links to every major servicer with the information that we know about them, of what they're doing and offering for forbearance. We're going to be getting into the details and the differences of forbearance versus deferment. It's another option. Generally, will have a bigger negative impact on your credit scores. But if you've had a loss of income, do not do anything without evaluating your options. And I think I'm a little biased. I think this is one of the best sources for information that you're going to get for accurate, unbiased information on what forbearance is, what all of your options are, and if it's a good idea for you. So what I would say is do not jump into it. We're on the 9th of April. This just started last month. For most people, they didn't have a loss of income prior to the 1st of the month. Don't jump into anything for the next 5-10 days. If you need forbearance, let's do the research, know what you're getting into, and we'll go from there. So hopefully you found this helpful. There's definitely plenty of information coming out. You'll see we're past that chaos in the market where everything was just nuts, and we were doing these updates day to day because there's enough information that we just needed to get in front of people and let them know. Markets definitely calmed down. We're not seeing big day-to-day swings in the bond markets, in interest rates, in changes in mortgage programs. So we're going to be here Monday night at 7, Thursday night at 7. So whether you're a borrower and in the industry, a borrower and in the market, or a professional in the industry, you need to know this. We're going to be here giving you the information that you need and the guidance to get through this. Hopefully 3, 4, 5, 6 months down the line, this is all in our rearview mirror. Most homeowners have protected their equity and are still sitting in a good position, but it's important that we remain calm, make good informed decisions, and that's what we're here for. So stay home, stay safe, be good to each other, and we'll see you guys Monday night.